Working capital is the difference between a company's current assets, such as cash, accounts receivable, customers' unpaid bills, and inventories of raw materials and finished goods, and its current liabilities, such as accounts payable. Net operating working capital is a measure of a company's liquidity and refers to the difference between operating current assets and operating current liabilities. They are derived from company cash plus accounts receivable plus inventories, less accounts payable and less accrued expenses. Working capital is a measure of a company's liquidity, operational efficiency and its short-term financial health. If a company has substantial positive working capital, then it should have the potential to invest and grow. If a company's current assets do not exceed its current liabilities, then it may have trouble growing or paying back creditors, or even go bankrupt. To calculate the working capital, compare a company's current assets to its current liabilities. Current assets include cash, accounts receivable, inventory and other assets that are expected to be liquidated or turned into cash in less than 1 year. Current liabilities include accounts payable, wages, taxes payable, and the current portion of long-term debt. Current assets are available within 12 months. Current liabilities are due within 12 months. The standard formula for working capital is current assets minus current liabilities. Working capital that is in line with or higher than the industry average for a company of comparable size is generally considered acceptable. Low working capital may indicate a risk of distress or default. Most major new projects, such as an expansion in production or into new markets, require an investment in working capital. That reduces cash flow. But cash will also fall if money is collected too slowly, or if sales volumes are decreasing, which will lead to a fall in accounts receivable. Companies that are using working capital inefficiently can boost cash flow by squeezing suppliers and customers. Working capital for management is very important because in order for businesses to remain solvent. In theory, a business could become bankrupt even if it is profitable. After all, a business cannot rely on accounting profits in order to pay its bills. Those bills need to be paid in cash readily in hand. That is why smart management pays so much attention to managing cash flow and maintaining a positive working capital situation.